Welcome back. So in this table, we're going to talk about kind of some different topics with regards to entrepreneurial finance versus corporate finance to kind of help you differentiate the two a little bit better. Okay? So we've got entrepreneurial finance on this. I guess if you're watching the video, that's on your left-hand side. And then you've got corporate finance on the right-hand side. So first, let's attack this whole thing of funding sources. In other words, where are you going to be able to get your money in entrepreneurial finance versus corporate finance? So let's start. Got these things in blue to help differentiate the colors a little bit. So if you are a new organization, a new entrepreneurship, a new venture, trying to get money, you might start with the 3 F's: friends, family, and fools. And I've got a whole other playlist on that very subject. But you're basically going to be borrowing from your personal savings, asking your friends and your family for money, or maybe you convince some idiot to give you some money. Okay? Kind of an impromptu sort of source of funding. Now you may use something like crowdfunding. Okay? You may go to like Kickstarter and ask potential customers to fund your project. And that's kind of cool. The next playlist, we're going to talk more about incubators and accelerators, but these are organizations that specialize in starting and growing and promoting new ventures. You might refer to a business angel. Okay? Business angel are those people that are successful entrepreneurs for the most part, and they like to invest in new ventures because it kind of helps keep some of their skin in the game. You might shift into a venture capital group. You know, venture capital is actually a form of private equity, but venture capital firms are organizations that specialize in investing in new startups. Or you might go to a private equity group, right? A hedge fund, or what are some other examples? Well, hedge funds are the best examples. Maybe a large mutual investment fund, et cetera, et cetera. But this is private equity. Okay. Now it's very different in corporate finance. Okay. Where do corporate finance usually get their money? They're going to go to banks and get a loan, or they're going to go to capital markets. In other words, selling stock in an existing company or selling bonds. These are things, banks, I've talked about this in the other playlist, but banks don't really like giving loans to unproven organizations. And capital markets aren't really possible for organizations that are not traded on a stock exchange, organizations that don't have audited financials, right? I mean, when's the last time you ever heard about Bob's Pharmacy giving out, a bond, right? I mean, it does, can't say that it doesn't happen, but it doesn't happen very often. Okay? So our next topic is, what does the funding process look like? Okay? So if you're in an entrepreneurial organization, you're probably going to do some deal sourcing and screening, trying to figure out who you can work with and stuff. You probably come up with your financial plan and or your business plan. There'll be some sort of evaluation, trying to figure out exactly how much your organization is worth, hypothetically speaking, and then you'll come up with the term sheet. So in other words, I'm going to give you 15% of my company for $36,000. These are my responsibilities to you as an investor, and these are your responsibilities towards me as the entrepreneur, right? And again, I always emphasize this. Whenever you work with private equity, venture capital, I would never, ever just give money for equity, at least not in the beginning. You want someone that's actually going to be a partner. Maybe they also trade, IT skills or marketing skills or a network or potential customers or something. There should always be something a little extra that comes with it. Okay, but that would all be outlined on your term sheet. Okay. Corporate finance, what do? You have some auditors. They come, they do their due diligence, they look at your financials. You come up with a financial plan again, and you might have to give up some collateral in order to secure that loan. Then we look at growth. What are some of the challenges of growth in an entrepreneurial finance venture versus a corporate finance venture? Well, you're going to be doing a lot of monitoring and getting those metrics. A new firm, you really need to get that data, so when you grow more, you can get more access to funding, and it also helps you figure out where you're doing well and where you're not doing very well. Corporate governance is going to be huge, right? You're going to want to start and get a board together, a board of advisors, and potentially a board of directors. Again, delegating what are your responsibilities as the entrepreneur versus what are their responsibilities in providing oversight. You're going to want to protect your knowledge, make sure that people don't steal your ideas. And of course, you may eventually have access to private equity at some point. On the other hand, with corporate finance, you're going to be doing a lot of capital budgeting. It's one of your big growth challenges. Where do we spend the money that we're making? Do we spend it on employees? Do we spend on new equipment, et cetera, et cetera? You might do some mergers and acquisitions. Now, what's a merger and acquisition? I've actually got a video on this very subject on my playlist, or on my YouTube channel. But, a merger means that two companies join together. It's almost like a marriage, right? But, marriages are very rarely equals, and neither are mergers, right? There's always some problems. And then there's also acquisitions, where one company buys another. Okay, so those are ways to get growth. You may also go to private equity as an established corporation. And you may launch an initial public offering or an IPO. Oops, kind of doing the dance, right? So, harvesting. How do you actually gain your money as an investor? Well, for entrepreneurial finance, it's when you can actually exit. And that's usually done through the IPO, right? So once you do the initial public offering, your new venture is going to be traded on the stock exchange, and you can sell out all your shares if you wish and get out of it. That's exiting. Or you can hold on to your shares, and maybe as the firm grows, you'll continue to make money, and maybe you'll get dividends at some point as the firm gets bigger, which again is part of corporate finance. They pay out dividends. What's a dividend? It's like my grandma, when she says she'd like another drink, she said, "Could you give me another dividend, please?" It's not exactly like that. A dividend means that a corporation distributes some of its profit to its owners, i.e. its shareholders. So it's kind of like getting interest, except it's related to the profits of the firm as opposed to interest on the loan. Fantastic. Well, I hope you've enjoyed this playlist, and I'm looking forward to seeing you in the next video. Did I say I hope you enjoy this place? I hope you enjoy this video, and I'm looking forward to seeing you in the next one. Sorry about that.